Welcome to the AB Study Partner. All right, step right up to the absolute ultimate legal showdown. In the blue corner, we've got the retail champion People's Stores. And in the red corner, the undisputed heavyweight of the South African economy itself, SARS. Today, we're looking at a classic clash that literally changed how we understand tax. Let's get right into it.
Hey, fellow classmates, if you're currently staring down an absolute mountain of tax law textbooks and questioning your life choices, well, you are in the right place. Today, we're translating pure, unfiltered tax speak into plain English so you can crush your exams. We're going to use some animated friends to break down this massive SARS court case because, let's be honest, reading 50 pages of legal jargon is literally nobody's idea of a good time. So grab your highlighters, get comfortable, and let's decode this whole shebang together.
Okay, let's dive into the setup. Our taxpayer here is People's Stores, operating out of Walvis Bay. They were a retailer selling exactly what you'd expect, clothing, footwear, daily essentials. Now, picture our first-year student here. He wants to look sharp for varsity, he desperately wants those fresh new tackies, but man, his bank balance is looking kind of tragic. People's Stores understood this struggle perfectly. So to move their merch, they didn't just demand cash up front. No way. They offered a super tempting deal to cash-strapped shoppers, letting them walk out of the store with the goods right then and there.
To make these sales actually happen, they used a 6 months to pay revolving credit scheme. Classic retail strategy, right? Here's how it worked. Our student gets his brand new clothes and tackies in month 1. He's looking good for lectures tomorrow, but he pays off the total amount over 6 equal monthly installments in rands. The rule was super simple. The installment on your statement had to be paid in rands before the next statement date rolled around. Sounds like a sweet deal for the student, and obviously a great way for the store to boost sales. But as we're about to see, offering credit creates a very, very sticky situation when the end of the financial year hits.
Now, here's the real kicker. The timing. The tax year comes to a close, and SARS takes a look at People's Stores' books. The store has made a ton of sales on credit, meaning they've handed over the clothes, but they're still waiting for months 2, 3, 4, 5, and 6 of those rand payments to actually hit their bank account. But SARS, they decided to tax the full amount of those sales in the very first year of assessment. Seriously? Imagine being the store owner. You're handed a massive tax bill for money you literally haven't collected yet. SARS essentially looked at the total sale value and said, yeah, we want our cut right now, even though the cash register was technically still waiting for those future rands.
Okay, to be fair, SARS wasn't totally heartless here. They did throw the retailer a tiny bit of a lifeline by allowing a Section 11J deduction. For my fellow first years, definitely write this down. Section 11J is basically the what if they ghost my bill provision. It's a tax deduction for doubtful debts because SARS acknowledged that realistically, out of all these students buying clothes on a 6-month plan, a few of them are inevitably going to default, block the store's number, and never pay the rest. So while SARS taxed the full amount upfront, they allowed a deduction to cushion the blow for that bad debt. But the core problem? It definitely remained. The store was still being taxed on a massive chunk of future unreceived cash.
So naturally, the store fought back, and they took this all the way to court. And this brings us to the ultimate legal drama of the case. The whole thing revolved around one seemingly simple word, accrue. According to the gross income definition, amounts have to be included in your income if they've been received by or accrued to you. People's Stores argued, hold on, how can this money have accrued to us if the contract explicitly says the customer doesn't have to pay us those rands until later? They figured accrual should happen when the money actually lands in their hands, or, at the very least, when the monthly installment date arrives. SARS, as you might guess, argued the exact opposite.
The court had to step in and make a massive legal distinction here. They looked at two distinct concepts, being entitled to an amount versus an amount being due and enforceable. Listen closely, classmates, because this is exactly where you secure your exam marks. The court ruled that gross income accrues when you acquire a right to an amount, meaning you are legally entitled to it. It absolutely does not matter if that amount isn't immediately payable, or in fancy legal terms, due and enforceable. Because the store sold the clothes and the customer signed that contract, the store acquired a legal right to those future rands immediately in month 1. They were entitled to the full value right then and there, even if they couldn't force the payment of the later installments until months down the line.
And this brilliantly illustrates the famous Latagan principle callback. If you've been doing your reading, and I hope you have, you've seen the Latagan case. In this specific judgment for People's Stores, the court firmly confirmed the meaning of accrued to exactly as it was applied back in Latagan. In South African tax law, the precedent is basically set in stone. Accrued to simply means you're entitled to that monetary value. Any right you acquire during the year of assessment that has a monetary value attached forms part of your gross income. The exact second that student walks out of the store with the shoes, having signed the agreement, the store is legally entitled to the total contract value. And just like that, CIRS is knocking at the door.
Now, you might be thinking, but wait, isn't the 6-month payment plan a condition of the sale? Well, the crucial point here is absolutely not. Please note that granting a customer credit doesn't act as a legal condition that delays the transfer of ownership or the finality of the sale. In contract law, a true condition, like a suspensive condition, normally delays ownership until a specific event happens. Like, I'll sell you this car if you pass your exams. That is a condition. But simply saying, here are the shoes, you can pay me the rounds over 6 months, that's just a financing arrangement. The sale is 100% done, ownership of the clothes has transferred, and the right to the income is fully established.
But wait, this creates a pretty massive valuation problem. CIRS gets to tax the future installments now, but 1,000 rands payable in 6 months isn't worth exactly 1,000 rands today, right? Inflation and the time value of money are very real things. So, step 1, the court initially ruled that those unpaid future installments had to be taxed at their market value. However, lawmakers quickly realized that calculating the market value of every single unpaid retail installment across the country was a complete nightmare. So, step 2. After this decision, an amendment was enacted into the law to use the present value instead. This means we mathematically discount those future rands to what they are actually worth in today's terms when calculating the gross income.
So, as a first-year student looking at this entire case from a bird's eye view, you have to ask yourself the ultimate question. Does granting your customers credit and letting them pay over time actually delay your tax bill to CIRS? I mean, you might be trying to do your customers a solid. You might be trying to boost your store's volume. But does the taxman actually care about your generous 6-month payment schedule? If you open a business tomorrow in South Africa and sell millions of rands worth of stock on credit on the absolute last day of the tax year, are you safe from taxes until the next year?
The answer, my fellow classmates, is a hard, resounding no. Because of the People's Stores case, the law is crystal clear. Once you're entitled to the money, once that right is established, CIRS is entitled to their cut. It doesn't matter if the cash is sitting in your bank account or if it's just a promise scribbled on a piece of paper. You are taxed on the present value of that entitlement. It's a harsh reality of cash flow management that literally every South African business owner has to learn. But hey, here is a wild thought to leave you with. If CIRS can tax you on money you haven't even received yet, what happens if the customer eventually defaults and that money literally never comes? Well, we'll tackle that exact loophole in our next session. Tax waits for no one, and neither do your exams. Please subscribe.